After the newest inflation numbers came out this week, President Biden held a statement where he said that our economy is strong and we don't have to worry about a recession coming ahead. Here's what he said. He said, quote, annual inflation has fallen by around 2/3 since last summer. Unemployment is at around 50-year lows. And third, we're growing the economy from the middle out and bottom up. And this is lowering costs for hardworking families, and he is making smart investments in America. This, according to President Biden, is Bidenomics. Now, the question is, do we have any risks in our economy today? Well, the interesting thing is just about a week ago, the Federal Reserve Bank also put out a statement saying that they no longer believe that the United States is going to enter a recession. Just a few months ago, the Federal Reserve Bank was saying that it seems that the United States will enter a recession by the end of 2023. Now they're saying no more recession ahead. Now, if you remember, just a couple of years ago, both the government and the Federal Reserve Bank were saying that inflation is transitory and we won't have any real effects of the high inflation. Well, here we are today in the middle part of 2023, and we're still working to bring inflation down. So I want you to understand that there are still risks with the economy, and let's talk about what they are. That way you can protect yourself and what's going on with inflation right now. But before we do, so a quick reminder, on August 15th, just a few days away now, I'm hosting my first ever live investor summit. I'm going to be talking about how our economy has changed, how money has changed, and how you can capitalize on investment opportunities in this changing economy. I'm hosting it on August 15th because on August 15th, 1971, well, that was when President Richard Nixon took the dollar off of the gold standard. So in this investor summit, which is free, I'm going to be going over how things have changed and how you can capitalize on investment opportunities here. So if you'd like to join me, I got the link to how you can join down in the description below. Just make sure you register because there's a limited number of people that can actually join. So going back into the inflation report, the inflation report says that headline CPI inflation is now 3.2% year over year, which is slightly higher than where we were last month, because last month it said that CPI was 3%. They also said that core inflation fell from 4.8% to 4.7%. Now you might hear that and say, wait, Jaspreet, did you just say that inflation is now 3.2% when last month it was 3%? Doesn't that mean that inflation rose? And you're correct. Inflation is higher now than where it was a month ago. But the reason why President Biden, and we've seen a lot of economists say, hey, this is good news that inflation is up a little bit, is because it isn't as high as what some people predicted. People were predicting that this last month's inflation report was going to be higher than previous months. And the reason why is because energy costs are higher. And now you might be thinking, how is this making any sense? People are predicting inflation is going to go higher, yet they're saying, hey, it's good that inflation went higher because it's not as high as they thought it was going to be. And the reason why is because the whole thinking is energy costs are very volatile. And so if we're seeing a spike in prices due to energy, well, that's okay because energy prices will probably come back down because of how volatile it is. So I'll let you judge on how accurate that is or not. But the second thing is that the Federal Reserve Bank is actively working to bring down core inflation. A lot of the media likes to talk about CPI, but the Federal Reserve Bank likes to look at core inflation, and core inflation has fallen from 4.8% to 4.7%. This is why the Federal Reserve Bank keeps saying in their meetings that they're working hard to bring inflation down to 2%, and there's still quite a ways to go. Because when you hear CPI is at 3 or 3.2%, you might say, aren't we really close to 2%? Yeah, on the headline number, but remember the Fed is looking at core inflation, which is currently at 4.7%, and still bringing inflation down from 3 to 2 is quite a ways to go, especially considering how we still have a lot of upward pricing pressures on a lot of different parts of our economy. So let's talk about how the prices of some things have changed over the last year. The items that have contributed to higher inflation are obviously housing. The latest CPI report says that rent costs are about 7.7% higher today than they were a year ago. Next, groceries. Grocery prices are up about 3.6% today than a year ago. Those were some of the biggest numbers. But let's take a look at what is causing inflation to kind of fall. Used car prices today are down 5.6% from a year ago. But even more than that, the CPA data says that flight tickets are down 18.2% 18.6% from 1 year ago. Now, I fly a lot, and this number, the flight ticket number, being down 18.6% from a year ago, I don't know if I can validate that number, because I can tell you that prices for flight tickets are still really expensive, but that's what the CPI data says. Now, the reason why this is really important to understand is because on one hand, we have inflation. On the second hand, we have the higher interest rates. And then in the middle, we have the economy. And when you have high inflation, that hurts the economy. And this is what we are seeing happen, because the higher cost of living is making it more difficult for people to spend. Now, yes, people are still spending today. They're spending by digging into their savings. They're spending by digging into credit card debt. And they're also spending by digging into their 401k. Earlier this week, I made videos talking about how Bank of America's latest report said that Americans are digging into their 401k with hardship withdrawals. That's about a 36% increase in hardship withdrawals out of people's 401ks from 1 year ago. So yes, people are still spending. The economy is able to grow because of that. But if people are digging into their retirement accounts and people are going into credit card debt, because now credit card debt is at its highest levels ever. We just passed $1 trillion worth of credit card debt. Spending is booming, but there's a cost to spending. When you spend more money, you're making somebody else rich. And when you have this high inflation, the cost of living goes up. You need to spend more money. And not only have we seen a growth in cost of living over the last number of decades and years, but we've also seen a growth in the standard of living. We want more nice things. We want better things. We want a better laptop. We want smartphones. We want nicer vacations. All these things were not there 10, 20, 30, 40, 50 years ago. And because of that, there's a higher cost of living and a higher standard of living, which means that people need more money to spend. However, wages have not gone up at the same rate as our cost and standard of living. And this is where it really starts to pose that question that, okay, on one hand, this inflation that we're seeing, this high inflation, is hurting the economy. Generally, when you see inflation, it hurts consumers, but it benefits investors and business owners. But now what we're seeing happen, because we've seen so much inflation, is that people are cutting back in some places. Yes, we are seeing people still spend by digging into the savings. Yes, people are still spending by digging into their retirements. Yes, people are still spending by digging into the credit card debt, but there's a limit to how much people can do of that, which means people have to cut back on some places. So if you own a business that people don't necessarily need your product to survive, it's a discretionary item, well, now people are being a little bit more cautious on how to spend there. And if we continue to see this happen, where people keep digging into their retirement or their savings or their credit card debt, eventually people are going to be tapped out, which would hurt businesses. So now what we're seeing is that the higher inflation hurts the economy. On the other hand, we also have the higher interest rates. We have the higher interest rates to cool down inflation. And yes, inflation has come down off of its highs. But even if the Federal Reserve Bank doesn't raise interest rates higher soon, they're still planning on keeping interest rates high. The Federal Reserve Bank has said multiple times that they don't have any intentions to cut interest rates, at least this year, which means that if the Federal Reserve Bank keeps interest rates high, that's going to keep borrowing costs higher, and that also hurts the economy, because when it costs more money to borrow money, less money gets spent. Because, well, if you have to pay more money to borrow money, you're less likely to buy a car, you're less likely to buy a home, you're less likely to put money in your credit card debt. And businesses are also less likely to go out and borrow money to spend in the business as well. So now when you have less spending, that also causes a slowdown in the economy, because remember, our economy runs on spending. The more money you spend, the more money somebody else makes. That's how our economic system works, which is why when you hear banks say the consumer is strong, they're spending their excess savings. That shows how strong our economy is. What that means is people are spending money. They're spending their life savings, which is good for the economy because it helps the economy grow, but it's not good for the consumer. And there's always these limits. You go through these waves where, yes, people are spending, and then people can spend more because of more debt. And then people can dig into their savings and their retirements, which means more spending, which is great for the economy in the short term. But that's where then you hit a top. That top happens when people cannot continue spending at the same rate as they could before. And when you hit that top, that's when you start to see the slowdown, because eventually people say, I can't keep going into credit card debt. I can't keep digging into my savings. I can't keep digging into my retirement. Now I need to save more. Now I need to pay down my debt. And then when people earn money, they're not spending it. They're using it to pay down their debt, and they're using it to save, and they're using it to invest. And now that changes spending, because then spending goes down. And if spending goes down, that's what slows down the economy. So that's why this inflation number is important to understand, because number one, yes, inflation is a little bit higher now than where we were a month ago, but we still have a ways to go with inflation. The inflation fight is not over, which means, yeah, we could see interest rates go higher. That's ultimately up to the Federal Reserve Bank and what they think is the best thing. We have a lot of opinions on that. I'm not going to go into that right now. But the Federal Reserve Bank is going to do what they think is the right thing. However, they are publicly stating that they do not want to cut interest rates anytime soon, which means that if interest rates stay high, that will continue to hurt spending, that will continue to hurt the economy, and the Fed can't really cut interest rates without impacting inflation, because if mortgage rates hypothetically went down to 3% tomorrow, you would see a flood of buyers into the market. If more buyers flood into the market, home prices would go back up, which then causes inflation to go back up, which creates that dilemma, because the higher interest rates are slowing the economy, but the Fed needs higher interest rates to prevent inflation from going any lower. So if inflation is still staying stationary where we are now, the Fed might need to get more aggressive to bring inflation down, which is why you want to pay attention to what the Fed is doing, pay attention to the economy, and pay attention to what's going on with inflation. Now, these are some of the things I'm going to be talking about in the Investor Summit, which is why if you have not registered yet, make sure you do so.